I'm going to show you how the Federal Reserve and its policies affect real estate, its prices, and how we operate our business on a day-to-day basis. What's going on, guys? This is Daniel, one half of the Kwok Brothers. Now, before we go ahead and talk about how the Federal Reserve affects real estate, don't forget to like this video and subscribe to our channel, guys. It really helps us push this video out in the algorithm. And it really helps us, of course, get this information out to as many people as possible so they can grow and learn just like you are right now. All right, so let's go ahead and talk about how the Federal Reserve affects real estate and what we do as investors on a day-to-day basis. So there's three things that we're going to start with, and I call it the big three when it comes to monetary policy. Now, monetary policy is pretty much how the Federal Reserve affects kind of like our whole economy and you and me on a day-to-day basis, but there's plenty of videos out in the YouTube world on what that is and what monetary policy means to you. But the big three is me and you, the consumers, the banking system, and also last but not least, our friendly neighborhood Federal Reserve. Now, the way this works is that the Federal Reserve loans money out to the bank, and that's what's known as the federal lending interest rate. Now, that is what typically makes the headlines, right? We see it on Wall Street Journal, on Forbes, on CNBC, and we hear about it all the time. And of course, unless you've been living in a cave, you know that the federal interest rate right now is at 0. And obviously it's as low as we can go unless we go into negative rates, which that's a whole nother topic for a whole nother video. So right now, the current federal interest rate is at 0. Now, obviously that interest rate is not the rate that we get from the banks in the form of commercial loans or residential mortgages or even HELOCs, right? I don't think I've ever heard of an individual getting a 0% 30-year mortgage. That typically isn't how it works. The way it works is that the Federal Reserve loans money out to the central banking system at a rate, which of course we discussed is 0. And then in turn, the banking system lends money out to us, which right now, the average 30-year residential mortgage is at 2.86% based on our last Tuesday's housing market update video. So let's go ahead and put this into practical terms in terms of real estate, where rubber really meets the road. Let's say we've got an 8-unit building right here, and we have 4 people interested in making an offer on that building. And let's say that each of those 4 people have a cash flow goal of, let's say, $2,000 a month. Their hope is that they're going to cash flow $2,000 a month from that 8-unit building. Now, yes or no, will the mortgage payment that they make to the bank affect their cash flow? Now, obviously the answer is a big whopping yes. The less that payment is to the bank, that debt service, the mortgage payment, the more that guys like me and you, the investors, put into our pockets. So here's another question for you guys. If that interest rate is at 6 or if that interest rate is at 3, right, which one is more likely going to be a smaller payment, right? A lower payment that we make to the bank? Obviously the one with 3%, right? So the lower the interest rate, and this is an obvious truth, the lower the interest rate, the lower our mortgage payment is to the bank. Now, let's say that the interest rate is at 6%, right? Obviously, our payment is a lot higher. And in order for our mortgage payment to be lower, what has to change? The purchase price, right? Because the lower the price, the lower our mortgage payment is going to be to the bank. So if that interest rate is really high, there's less money that we can offer because we have to meet our cash flow goal of $2,000, or at bare minimum, it has to cash flow positive every single month. Otherwise, we're going to be in some pretty big trouble. So what does that mean, right? If the interest rate is really high and our offer has to be lower because our mortgage payment has to be at a certain level for us to make money with this 8-unit building, what happens if we flip it vice versa? What if the interest rate is really, really low? Well, that means that we can afford to make a higher offer to that individual with the 8-unit building to still maintain our cash flow goals. So what happens when the interest rate is a lot lower? Well, it happens for all 4 of those people, right? All 4 of those people are able to make a higher offer because we're still able to meet our cash flow goal of $2,000 a month. Well, right now, the interest rate is at 0, meaning what? Well, it means that a lot of individuals are able to make an offer that's a lot higher than normal. Well, that's kind of what we're seeing right now, isn't it? Prices are overly inflated because it's the lowest that we've ever seen our 30-year residential mortgage. We have a huge price inflation with our residential housing market right now, and the inventory is really, really low. And it's the same thing with the example that we're using here with this 8-unit building, because not only are those 4 people able to offer a higher purchase price, the low interest rate increases what's known as the consumer purchase power, meaning there's more than 4 people that are going to be interested in that 8-unit building, thus increasing the demand. And whenever we see the demand go up, typically we see the supply being commoditized, meaning it's worth more because there's more demand surrounding it. It means more people are interested. So here's a really good rule of thumb, a rule that I use to pretty much help me gauge the prices based on where the interest rate is at. Now, obviously, there's a lot of factors that go into it, but my rule of thumb is for every 0.25% that the federal interest rate goes up or down, it changes the value of an asset by 10%. Now, obviously, that depends on the classification, but that's pretty much my general rule of thumb that I like to use, especially for middle of the road multifamily buildings such as Class B or upper Class C, that I use to pretty much gauge values of certain properties if you're looking at an overall 10-year market cycle. So hopefully that helps you better understand how the Federal Reserve affects real estate. Don't forget to subscribe to our channel, guys, and like this video and share it with your friends and family. I'll see you guys in the next one.